what yield curve inversion is, look at all of the yields, and then get to a place of where the yields that we trade, where they're at, and where there are some potential trades for inversion or against inversion. First of all, yield curve inversion is just when short-term yields are higher than long-term yields. And this can happen a multitude of ways. Like Jermal says, the threat right now is like short-term yields are climbing, and then medium and long-term yields are not really climbing. And so the threat would be short-term yields climb so much that they overtake, the 5-year or the 10-year. So I guess looking at the 2-year, it climbs so much that it overtakes the 5-year or the 10-year or the 30-year. And thus you have an inversion, short-term yields being higher than long-term ones. Also, you can get an inversion on the way down, which is usually the more common scenario, which is like stock market craziness is happening. The Fed is scrambling to reduce rates. People are buying bonds and notes like mad and driving down yields. And in that process, in that confusion and craziness, you'll see all yields moving lower, but maybe the 10-year moves lower than the 5-year or the 2-year, or the 30-year moves lower than the 10-year or the 5-year or what have you. I mean, is this at least enough examples to get the idea of inversion across here?
Certainly, yeah. And this is a proposed, right? Like, this is not what we're actually seeing.
No.
This is just if the yield curve where we're saying it was inverted right now, 2 years would be trading above 10, for example, right?
Yeah, this is just an example of how this would look, which is like you've got your x-axis, which is duration. And that can be as little as, a 1-month treasury bill. It can be as much as a 30-year treasury bond, but in the midst of that, you've got the 2-year treasury note, the 10-year treasury note, and the 30-year treasury bond. And so across that duration, then on the y-axis, it would be essentially, one of these shorter dated yields, something that has a smaller duration, is higher than something with a longer duration. This is not where we're at. We'll show you where we're at here in a second, but this would be an example of inversion. Now, what's interesting, and actually a big shout out to my father, the person who sired me, he hit me up and was like, hey, is the yield curve inverted? And he sent this to me maybe end of last week or early this week. And I just responded, no, old man, you don't know what you're talking about. And which is the common response for most things in our relationship. But digging into it, there is a slight inversion, both in the short and long end of the yield curve. That being said, it comes with the disclaimer of like, there's a lot of choppiness. When you put the magnifying glass on the treasury bills in the short term and look at that, make sure you look at these column headers here. This is 1 month, 2 months, 3 months, and 6 months out. We don't trade any of this stuff. It's not accessible. And for good reason, there's not a lot of activity in here. They're all right near 0% yields because the Fed's at 0 and there's just not a lot of movement. And then also the other piece, which is actually more relevant, I think, and is probably what my father was looking at, is in the longer end between the 20 and 30-year treasury bonds there is a slight inversion. You can see that this 20-year is at about, as of, the 29th and 28th, and all this information is accessible at, I believe, treasury.gov. You can go look at this stuff and scrape the data if you want. But you can see here that the inversion hits on the 28th, where 20-year debt is seeing a yield of 1.98. It doesn't change from the 28th to the 29th. And the 30-year debt is actually at 1.96 and 1.93. So a slight inversion there.
Yeah, slight. And I was looking at the first box that you circled too. I see on 10-1. I mean, like you said, those are very small changes. But on 10-1, the 1 month was just slightly above 2 months and 3 months and 6 months. But it fluctuated so much, like you said, over the month. I mean, when you look at the end of the month, you see they were all kind of, although 2 month was a little bit higher there. But this is fascinating. I mean, you can, of course, look and see across these durations how many times there's changes. But for the most part, to your point, we're not super inverted. Also, I'm interested in the fact that your dad sent you this cutout from the Gov. I mean, you guys are two peas in a pod. That's amazing.
he didn't send me this cutout. I made this myself. I put my big boy pants on and I made the cutout myself. Thank you very much. I don't need his help on my school projects anymore. But no, he just brought it to my attention. He was like, "Oh, this is it," and I'm sure he just read it on Twitter from some talking head saying, "Hey, the yield curve is inverted." And my response to him was a lot kinder for those of you out there who are fathers. I
knew it. I knew you'd get bust up if you said something like that. I didn't.
Though I'm in considerably better shape than him, he does have probably 60 to 100 pounds on me. And the dad, I think, until their dying day, can beat up the son. There's something emotional there, or what have you. You know, because your son is pretty large. Like, he plays football and everything, right?
He plays football. He's not pretty large. I'm still bigger. Don't worry about it.
Oh, there it is.
He's gaining some weight. He's getting up there. I mean, but I still got the size advantage on him. So when we look at these 20, so just more recently, we're seeing this move in the 20-year and 30-year durations then, huh?
So that's the piece that's more intriguing. Like I say, the chippiness in the real short term, and this is essentially, people who've watched the show before have heard me use this term, growing pains, which is like the Fed is likely to hike rates in the next year or so. And thus, the next 6 months out, they're not likely to do anything. But these yields are kind of moving back and forth depending on the day. But an inversion of 1 or 2 or 3 basis points in a market that's essentially at zero. These are all rounding errors, in my opinion. But when you start to see this kick in over here, which is inversions between 20 and 30 years, that's 10 years of duration that you've got an inversion amid there. And that's pretty significant. And then if that bleeds over, we're tracking to get to a point where 20 years and 30 years move lower or stand pat as 10 years and 7 years and 5 years, 3 and 2 years move a little bit higher. So that's something that's interesting to me. And that's what's been translating to the knob spread, which we'll end at here in a second, because this is where we're actually at. And it's nice to go to treasury.gov, look at all the rates and kind of get a handle on this stuff every once in a while. But at the end of the day, you're only trading essentially the 2-year, the 10-year, and the 30-year.
Yeah, I actually heard that the other day. And I think I talked about it briefly about how the 20-year duration was, there was an inversion between 20 and 30 year for the first time. But they just introduced that 20-year duration again last year, right?
Well, so they've this is a funny thing where the durations have technically always existed, and the government has always monitored them, but trading products have pretty much only existed for the 2, 5, 10, and 30 year primarily forever. But they've created ultra 10 years and ultra 30 years and these different kind of durations that move around them. But for everybody at home, all this stuff is interesting. Having the data and the facts and everything is good to have a handle on, especially the trade that we're going to conclude at does kind of harp on if this trend that you're seeing down here in the bottom right corner, this recent trend, if it gets bigger and takes over, more of this curve, we start to see these inversions play out in, the 5 to 10 to 30 year, that will actually start to shift stuff that we look at. But for all intents and purposes of the everyday trader at home, looking at 2s, 10s, and 30s, there isn't an inversion here, but we're as close to an inversion as we've been. And this is where stuff that we've already built a foundation on, this is where the knob spread and all these different yield curve spreads come in. The knob is the closest major spread to inversion. And right now it's sitting at about 40 basis points of difference. It's at the lows that it's been at all year, the last couple of years here. And we can tie it back to this data. Look at right here, the 10-year and the 30-year, the 10-year at about 1.55, or let's just round it to 1.6, and the 30-year at 1.96, or let's just round it to 2%. That's 40 basis points of difference, right? And that translates right to the spread that we're trading with S30Y and S10Y. Now, Jermal, we're here on the precipice of a potential inversion. Parts of the curve are inverted, but the parts that we trade are at this precipice here. Are you of the mind that you ride this train lower and you're looking for that inversion, or are you looking to get on the other side of this, playing the odds, so to speak? And I even put it out there. The knob spread, the 30 to the 10-year, has only been inverted 3% of the time going back to 1990.
Yeah, so those are the two reasons. There's two things that will make me wonder and why, if I want to trade it or not. So this is a key point right here. When you say it's only been this time 3% of the time, does that mean forever, like across time periods? Like this is the only time it's been like this? Well, the only 3% of the time across time. That's what you're saying.
So the knob spread, the difference between the 30-year and the 10-year, which is probably our most popularly traded part of the yield curve that could go inverted or not, it's only been inverted 3% of the time since 1990. So it has gone inverted before, the yield curve. And I'm sure you remember in your history of trading news stories that are like yield curve inverted and what that means for the economy and everything else, because it does usually portend stock market pessimism when you have a yield curve inversion. But I'm sure you also remember it doesn't happen very often. And when it does happen, it doesn't stick around very often.
So that was going to be my next question. I certainly have heard about yield curve inversions, but I haven't always paid much attention. But now that I'm more informed, thanks to you, my friend, about yields, bonds, when was the last inversion? These are the things that I think about. So those are the two things that would help me decide how aggressive. Certainly, I'm interested in trading it now. How aggressive I want to trade it those are the two things. Seeing the 3%, it's like, okay, I'm already interested. Now, how aggressive do I get? When was the last time we had an inversion of the 30 and 10? And that determines to me the size that I want to do a little bit. That's how, that's how traders are. That's what, at that point, when was the last time this happened and what were the conditions in the market? And that makes me decide how great of an opportunity I think it is. It already sounds like a great opportunity because, again, the 3% since 1990, that's like very interesting. But then last time we saw it, that's where, okay, now I'm really even more interested. I'm already going to put it on. How many times do I want to put it on? Or how much farther do I think it has to go before, certain things happen? So that's where my interest lies.
Your computer screen isn't broken, by the way. This is Frank in real time trying.
This is how Frank thinks. Frank is in the matrix right now. This is he can process these faster than any of you can see it. He's doing it. This is this is it. He thought it was a fake thing. Nah, it's real. It's straight up real. And he's doing it. He's doing it while he's interacting with me and all of us right now. He's doing it. Ballpark though, what do you think? Like how far are you going back, do you think? I'm
finding it for you, baby doll. This is so we're back in. So and we can actually maybe stop here. This column is what I'm looking at. This is the knob spread. And this here is, this unit right here, that's 12 basis points of difference, which is lower than where we're at. We're at right now about 40 basis points of difference. But this is as close as I've seen to inversion. And this is the middle part of 2007.
Okay. There we go.
But I want to find a negative value for you. I want to find the last inversion because it's definitely it's got to be, come on. But we're in 2006 now. There we are. Okay. The last day that the knob spread was inverted, March 10th, 2006, everybody.
Oh, that's before I started trading. I started trading July 10th of 2006.
And we get inversion. Since then, you've seen inversions probably between like maybe the 2-year and the 5-year, or the 5-year and the 10-year.
2-year inverted 2 years ago. I remember that.
And also there were some low values back in 2018 when stuff was wonky, the yield curve was low on the whole, and there was some inversion there. But yeah, the last time that the 10-year and the 30-year was fully inverted was 2006 there, March of 2006, which isn't to say like it can happen, but it happened once in the last, call it 20 years. And it doesn't stay there very often at 3% of the time. And so this is why we put together these statistics. And I'm glad that you asked that question, Jermal. And we found it in real time there, that last date, because this is what we lean on in futures is like, wow, okay, this hasn't happened since 2006. It only happens 3% of the time. and we're really close to it happening. I'm going to get on the other side. Like, that's how my brain works. A lot of people out there might be betting on inversion. And if you are betting on inversion, then you would be selling the 30-year yield and buying the 10-year yield. But my brain works in like a manner of, hasn't happened since '06. It only happens 3% of the time. So when it gets there, it doesn't stay there long. And I'm going against, I am going to bet on the thing that usually happening. I'm good. Let's take it full circle. Alabama wins 9 out of 10 years. I'm betting on Alabama winning, right? Like, it's more fun to bet on inversion. It's more fun to bet on Cincinnati, but it's Alabama year after year.
True. Although you don't get as good odds on that. I think I like my odds better on this knob spread. And again, I'm glad we discussed this because I wanted people to understand. I know there's people out there saying right now, oh, cool, I'm going to jump all in with both hands. Well, again, like you just pulled, as you noticed, as you mentioned, it can still get to the point of inversion. We're really low, we're really close. So put on a trade, but don't go, I was about to say something else. Don't go too long, and I was about to say something else for two, but don't go super long. Just, kind of work your way in like we do with every trade, right? Like we do with all trades.
And what's really nice about this is, so here you have the trade in your platform. This is the knob spread that is still right within. We were just a tad lower a couple of days ago. The 30-year yield has come back a little bit, barely anything. But just to give you some scale as well, buying the spread down here at 40 basis points of difference. If we do get to inversion, and when we have been inverted, it's been by a couple of basis points. I don't think we've ever seen, at least in my data since 1990, a yield curve that is inverted by like 40, 50 basis points. It's usually a couple. It gets down to flat and it just gets slightly inverted. The difference, if you were to buy this spread and play the odds in your favor, if we do get down to inverted, it's only a $400 loss. And so and now I'm not saying that that's not a lot of money, but the doomsday scenario, the outlier being, yield curve inversion, $400 standing between you and doomsday is truly not a lot, especially when you think about, like, oh, if I buy this stock, it could go to zero. And it's like, man, Amazon, that's thousands of dollars if the doomsday plays out. Here in the knob spread, it's a nice small trade with that outlier statistics in your favor if you are looking to buy the 30-year and sell the 10.
I mean, I think we accomplished a lot here today. You showed everybody how the matrix works, and that was pretty awesome. And he found it. Frank found it.
I'm glad you asked me something that I had readily accessible. Cause if I didn't have that workbook, I've got a bunch of tabs open here. If I didn't have that workbook down there, I'd be like, dang, he stumped me. But I was like, you know what? We got this, we got the data right here. And that's what I love about this network is like, these are all just data points. This isn't me being like, the yield curve is going to go inverted. And it's like, why, Frank? Because I think so. No, it's like, we've got all the data here, man. It's all good.
Yeah, no doubt. That's awesome.
Absolutely. Awesome, man. Thanks so much for joining me here on Small Stakes. Always a good time with you, my friend. And people can find you on your show at what time?
Engineering the Trade at 1:30 Central, 2:30 Eastern. Last I checked, unless there's been a difference in that spread, but there hasn't. So hour apart. Yeah. So
time is not inverting, thankfully.
Thankfully not. But I'll be on a little later on. So yeah, catch people later in about an hour.
Everybody go catch Jermal's show and also catch Splash into Futures. Coming up next, right here, Pete Molmad is going to join me in the trading platform for a bunch of trades on another wonky day in the market. Thanks for watching, everybody.